Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today's Wednesday, July 1st, 2026. We're Elena and Marcus. And to really set the stage for you today, I want you to imagine being a primary hardware supplier for a major tech conglomerate.
Right.
And you suddenly get word that their infrastructure budget for next year, well, it might be $175 billion, or it might be $275 billion. That $100 billion guessing game is precisely what triggered a massive earthquake across global semiconductor markets today.
Indeed. We are looking at a market that is really just grappling with one profound overarching theme right now, which is uncertainty.
Correct. And we have three critical developments from today's proprietary updates to map out for you. First, the Sinter shockwave, where the Federal Reserve just removed the market safety net by abandoning forward guidance. Second, a violent bifurcation in the AI sector as capital rapidly flees tech hardware and, floods into software and financials.
Understood. And the third is a disinflationary anchor in the commodities market that is really completely reshaping the whole soft landing narrative.
On that point, if you only look at the headline index numbers today, you would think nothing happened. I mean, the S&P 500 closed down a very modest 0.22%.
Correct. But looking at our daily desk data, the underlying surface of the market is experiencing extreme, violent factor rotations. And to understand the catalyst for this, we must first dissect the macroeconomic environment, specifically the policy shifts originating out of Portugal today.
Moving to today's data on that front, Federal Reserve Chair Kevin Warsh appeared at the European Central Bank's Sintra Forum. He explicitly stated that inflation risks have come down.
Right.
But the dominant takeaway from our latest run of policy analysis is his deliberate structural refusal to offer any forward policy guidance.
Indeed. The market was forced to digest that sudden shift in the Fed's communication strategy right alongside highly conflicting European data, because the Eurozone's CPI flash print provided a downside surprise today, coming in at 2.8%.
Understood. And that immediately triggered a split signal among European Central Bank members, right?
Correct. We saw dovish commentary from Sterneras highlighting the drop in inflation, which was then countered directly by hawkish posturing from Kasich, who publicly argued for at least one more rate hike. This injection of global policy uncertainty immediately repriced the U.S. yield curve.
On that point, I want to apply a first principles approach here for you, our listeners, who are navigating these mechanical shifts. From a high-level desk perspective, before we get into the exact yields, we need to understand the real-world implications of these two things. First, what does a steepening yield curve signal to a regular investor about the economy? And second, why does the Fed's refusal to provide forward guidance matter so much?
Understood. Well, to answer the second part first, operating a market without central bank forward guidance is akin to driving a car without a GPS, or, playing a high-stakes game of poker where the dealer is allowed to change the rules every single time a new card is flipped. Every upcoming economic print, especially tomorrow's non-farm payrolls report, is no longer just a standard data point. Without the handrails of central bank guidance, it becomes a highly volatile binary event.
Correct. And that uncertainty is exactly what is driving the aggressive shifts in fixed income. Moving to today's data on the curve, the 2-year yield currently sits at 4.170%. The 10-year yield drifted higher to 4.480%.
Indeed. And most critically, the 30-year yield is perilously close to the 5.0% threshold, closing today at 4.974%.
Right. So we are seeing definitive yield curve steepening across the board. Specifically, the 10-year, 2-year spread hit positive 30.3 basis points, and the 5/30s spread widened to positive 73.3 basis points.
On that point, to answer the first part of your first principles question, what does that steepening communicate? Fundamentally, a steeper curve implies the market expects resilient long-term economic growth. Investors require a much higher premium to absorb long-term debt because they are betting the economy will survive this new policy regime.
Correct. They want their capital tied to long-term growth rather than just parking it in short-term safety. Or, alternatively, it reflects a growing structural concern over the sheer volume of long-term debt issuance coming to the market.
Indeed. And this complex macroeconomic rate environment connects directly to how institutional capital is aggressively repositioning in the equity markets today. The divergence between the headline indices and the internal market mechanics it's very stark.
Right. As we noted, the S&P 500 closed at 7,483.23, down just 0.22%. But conversely, the NASDAQ 100 fell sharply to 29,809.43, closing down 1.54%.
Understood. Yet our daily desk data shows that overall market breadth was actually positive today. The vast majority of the constituents within the S&P 500 advanced, meaning the drag on the index was entirely concentrated in one specific area.
Moving to today's data on sector flows, that drag was an extreme sell-off, isolated within upstream AI hardware and semiconductors. Our positioning data flags a massive Z-score of negative 4.0 in outflows for U.S. information technology.
Indeed. And to put that metric in perspective for you, a negative 4.0 Z-score is not just a standard down day. Mathematically, it represents a multi-standard deviation panic. It signals extreme institutional profit-taking and a violent mechanical de-risking event where capital is basically running for the exits in tech hardware.
Correct. Looking at the specific movers driving that negative Z-score, CoreWeave plummeted 14% and Nebius fell 17%. ASML dropped 4.6%.
On that point, globally, this hardware unwind had severe systemic consequences. Samsung fell 5.8%, which directly dragged the KOSPI down 5.8% amid a broader AI leverage unwind cascading through Asian markets.
And the fundamental driver of this rotation, moving to today's data, is a fierce institutional debate over compute capacity and capital expenditure sustainability, specifically centered around Meta.
Understood. The buy-side estimates for Meta's 2027 capex are demonstrating wild uncertainty right now.
Correct. As we touched on at the top of our briefing, institutional consensus ranges anywhere from $175 billion to $275 billion. That $100 billion delta is causing hardware and semiconductor investors to panic.
Indeed, because if you are a supplier, you cannot model future revenues, manage your supply chain, or issue guidance with any precision when your primary buyer's budget has a $100 billion variance.
Right. Yet, while the hardware suppliers collapsed today, Meta shares surged 8.8%. Investors are heavily rewarding the platform companies while actively punishing the shovel sellers.
On that point, it's also worth noting that Apple, ticker AAPL, was initiated as a top buy idea across dealer desks today with a $340 price target.
Correct. The thesis there is driven by an anticipated consumer AI upgrade cycle, which suggests a pivot from data center AI spending toward consumer edge AI monetization.
Understood. But I know you have some thoughts on this hardware narrative.
Indeed, I have to push back a bit on the AI hardware panic we saw today. Looking closely at today's proprietary updates, is the extreme variance in Meta's capex uncertainty truly a definitive signal that aggregate AI demand is peaking?
Right, that's the big question.
Or are we simply witnessing a necessary market transition to a tiered pricing environment? I mean, it stands to reason that older generation GPUs might be moving into a monetization and inference phase, while underlying demand for next-generation training models from hyperscalers remains highly robust.
Correct.
It seems highly premature to declare the physical infrastructure build-out over based on a single session of factor degrossing.
Understood. And your skepticism regarding peak demand is supported by other segments of today's data deck. But before we get to the physical commodities that prove your point, we must contrast this specific technology weakness with the significant surge we tracked in the financial sector today.
Moving to today's data, the Financial Select Sector SPDR Fund, ticker XLF, closed up 2.2%.
Indeed. Our latest run attributes this direct influx of capital to approximately $18 billion in flagged capital returns following the recent regulatory stress tests.
On that point, those stress tests are critical for you to understand. When banks clear these regulatory hurdles, it unlocks their ability to execute share buybacks and issue dividends.
Correct.
That $18 billion essentially serves as a massive liquidity catalyst for the entire sector. The individual movers reflect this perfectly. S&P Global, ticker SPGI, rallied 7.7% today. Robinhood, ticker HEHOD, surged 8.3%, and Interactive Brokers, ticker IBKR, closed up 7.1%.
Indeed. And the institutional flows behind these specific sector moves are highly instructive regarding the broader market mechanics. We tracked severe hedge fund degrossing throughout the trading session.
Right.
This rotation from tech to financials resulted in the outright destruction of the momentum factor, which closed down roughly 10% today. It was its worst session in a year.
For context, the momentum factor is essentially a quantitative strategy utilized by massive funds to buy what is currently going up and sell what is currently going down.
Correct.
When a dominant trend snaps, like the long-standing rally in AI hardware, these algorithms are forced to mechanically liquidate, and that creates a violent feedback loop that exacerbates the sell-off.
Understood. And moving to today's data on derivatives, our options flow metrics flagged a massive institutional trade, confirming this expectation of continued volatility. We saw an S&P 500 August 31st, 7,750 strangle and executed for $115 million in premium.
On that point, executing a strangle of that sheer magnitude means institutional players are aggressively buying forward volatility. It is important to understand how a strangle functions.
Right.
The institution executing this trade is buying both a call option and a put option at those wide strike prices. They are completely agnostic to the direction of the market. They do not care if the S&P 500 crashes or skyrockets.
Indeed.
By deploying $115 million, they are operating on the conviction that a massive directional break is imminent, regardless of which way it goes.
Correct. And that conviction is likely tied directly to the new policy uncertainty regime established by Chairman Warsh today. The macro environment is dictating these flows.
Understood.
Moving to today's data in commodities and hard assets, we must address the disinflation engine that is driving the broader economic narrative. We observed a massive collapse in energy prices today. Brent crude settled at $71.20 per barrel.
Right, and that represents a substantial 28% drop from its June highs. West Texas Intermediate, or WTI crude, settled at $68.09 per barrel.
On that point, the mechanics behind this collapse in oil are tied directly to fading geopolitical risk. The premium associated with the U.S.-Iran conflict, which had markets pricing in severe supply chain disruptions, is rapidly exiting the market.
Correct. Mechanically, this specific drop in input energy costs is exactly what is driving the cooler inflation prints we discussed at the top of the briefing, including that Eurozone downside surprise.
Indeed. However, despite this disinflationary signal from the energy market, we are tracking a highly significant safe haven divergence. Gold surged heavily today, closing at $4,030.65 per ounce, representing an intraday move of positive 2.7%.
On that point, I want to clarify a structural dynamic for you regarding gold, and I actually have a question here. If inflation is visibly dropping, as evidenced by the 28% collapse in oil and interest rates are stabilizing with the yield curve steepening, why is gold surging to these elevated levels?
Right.
Historically, gold tracks as a direct hedge against inflation. So if inflation is cooling, gold should theoretically be selling off.
Understood. But the foundational utility of the asset has shifted dramatically in the current macroeconomic regime. Gold is no longer acting solely as a traditional inflation hedge.
Correct.
Based on today's data deck, institutional consensus views gold as a direct structural hedge against the Federal Reserve's new policy stance. The sheer magnitude of policy uncertainty being injected into the system by the elimination of forward guidance makes holding a zero-yield safe haven asset highly attractive.
Indeed.
Investors are buying gold to insulate their portfolios against the inherent volatility of upcoming REIT decisions, which are now entirely untethered from central bank signaling.
Moving to today's data on industrial metals, we see direct confirmation of the pushback regarding AI hardware demand that we discussed earlier. Copper remains highly elevated, closing at 610.25 cents per pound, which is $6.10 per pound.
Correct.
Dealer desks connect this pricing directly to the ongoing fundamental physical demand from AI data center buildouts, coupled with manufacturing stabilization data out of China.
Indeed.
This proves that the physical constraints and material requirements of the AI infrastructure build are still entirely real and completely independent of the violent algorithmic equity rotation we saw in the semiconductor space today.
Understood. And we must synthesize this vast array of data across asset classes to map the broader economic regime we are entering. When we connect the plunge in Brent crude oil, the steepening of the 10-year, 2-year yield curve, the massive liquidity rally in financials, and the specific drop in the ISM Manufacturing Prices Paid Index, which fell a massive 8.9 points today, down to 73.0, a very clear institutional narrative emerges.
On that point, the market is aggressively pricing in a Goldilocks soft landing scenario. An ISM Prices Paid Index dropping to 73.0 indicates that input costs for manufacturers are collapsing.
Correct.
The data suggests the broader economy can maintain resilient baseline growth without the burden of supply chain or energy-driven input cost inflation. That specific combination of growth without inflation is the exact macroeconomic condition required to sustain the current equity multiples outside of the technology sector.
Indeed. And tomorrow's non-farm payrolls report serves as the ultimate definitive test of this Goldilocks regime. Institutional consensus expects 115,000 jobs to be added to the economy, while internal desk estimates are tracking slightly higher in the range of 125,000 to 130,000 jobs.
Understood. And because of Chairman Warsh's firm stance on eliminating forward guidance, the stakes for this specific payrolls print cannot be overstated.
Right.
A hot labor print tomorrow Coming in well above those desk estimates could push the odds of a July rate hike drastically higher. That outcome would immediately upend the soft landing narrative, likely reversing the massive gains we saw in rate-sensitive sectors like financials and defensives today.
Correct. The market is entirely reliant on tomorrow morning's data release to price the next month of capital allocation.
Moving to today's data synthesis, I want to leave you with a forward-looking macroeconomic thought to consider as you review your own positioning. Today's proprietary updates introduce a concept we are calling the J-curve contradiction.
Indeed.
Over the past year, the market has fervently priced in immediate exponential productivity gains from artificial intelligence. However, rigorous macroeconomic research indicates that the actual realized productivity gains from AI will likely follow a delayed J-curve effect.
On that point, we can look to historical parallels to understand this mechanism. This delayed curve is highly similar to the multi-year lag the global economy experienced during the information and communication technology revolution from 1980 to 2000.
Right.
During that era, massive capital was deployed into computing infrastructure, but it took years for corporations to restructure their workflows to actually utilize that computing power effectively.
Understood. The economist Robert Solow famously stated during that period that you could see the computer age everywhere except in the productivity statistics.
Right.
The contradiction today lies in the market's expectation of timing. If these massive hyperscaler investments in AI hardware require a multi-year gestation period before they actually boost broader economic efficiency and corporate margins, the market may be fundamentally mispriced for the short term.
Indeed.
The critical question for you to consider is this. Are institutional investors properly positioned to wait out a potential multi-year valley before the true systemic return on investment of this infrastructure build-out materializes?
Correct. And the violent rotation out of AI hardware and semiconductors today suggests that institutional patience is already wearing thin, forcing capital to seek immediate returns in sectors like financials.
Understood. It is a critical dynamic to monitor as we move through the third quarter. To quickly recap today's core takeaways, we are navigating a highly volatile Federal Reserve regime that is now entirely devoid of forward guidance.
Right.
We witnessed a violent algorithmic equity rotation out of AI hardware and into software and financials, effectively destroying the momentum factor in the process. And finally, a commodity-driven disinflation narrative, anchored by crashing oil prices, is setting the stage for a highly consequential non-farm payrolls print tomorrow.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.